Alright guys, welcome back to the channel, and in today's video I want to detailedly explain this kind of ICT model. I don't want to target to ICT model, but this strategy called the candle range theory entry model. So I've made some videos. I even have a playlist on this particular trade entry model, but I don't think I've ever explained it enough to some extent. So this very video I want to detailedly explain candle range theory model. Now let's first of all try to you know um define the name separately. Let's just see a range. This is a range. What a range looks like here. From a high to a low. This is a old high to this old low. So this is actually a range in price where we have this to be a high and this to be a low. Now this is a range of price action, from one high to another. So we have this level from this low to this high to be a range, and the name of the strategy is candle range theory entry model, the CRT entry model. So let's just say this whole range here is a candlestick. It's candlesticks that trade into this level like this. Let's say behind the range is filled up with candlestick. It's like this is the range, although I'm just drawing it this way. These are candlesticks going up to and fro to this level. So these are candlesticks here. So this is a range in price. This is our candlestick. So the candlestick range theory model is simply a strategy that has to do with a kind of liquidity sweep. Now, a liquidity sweep that always happens either at the high of the price or at the low of the price of this range. Now, everything here depends on the time frame you're using. Let's just take this to be a 4-hour time frame. So once liquidity has been swept below this ERL, this is an external range liquidity, this low external range liquidity. Once you have a liquidity sweep below this low, you're going to have a rejection in price action. So the rejection is what you want to trade, and this rejection should last up to at most 40% of this whole range here. That is how we trade candlestick range. So if you use more like your Fibonacci tool on the chart here, your Fibonacci retracement. So whenever liquidity is being swept here, you want to trade this other line, this middle line here. Let me show you something. This middle line here is the 50%. So you want to trade at most to the 50% before you continue selling. So that reaction of liquidity sweep is what you want to trade. That's the whole candle range theory entry model. So you just want to look for entry after a sweep in liquidity to at most target the 50% of the overall range of this price action. So that's how the strategy works. So let me show you something using the schematic diagram. So let's just say this is what price will do here. We have a sweep in liquidity now. Then we trace to at most 50%, provided this is a 4-hour time frame. We trace to at most 50%. Then continue selling. Continue selling. So that's it here. So what we want to actually trade is this small sell. Sorry, is this small buy here. After the sweep of liquidity, we want to trade this small buy to at most the 50% here before we leave the market, or to at most a very good point of liquidity, which is this old high here. Yes, that's it. So if this is a 4-hour time frame, you look for a confirmation after the sweep of liquidity. Maybe around there will be your confirmation. Then you target the next high. Let me see if I can draw this thing here. So after a sweep of liquidity, you enter right around there. You put your stop loss below this low. Then you target the next liquidity, which is this one. This next liquidity. Just that little retracement is what you want to catch here. That's what you're after. You're not after the whole price action. Just want to trade more of it and you leave the market, provided you know what you want to do in the market. And now let's just say, for instance, now when this price action gets interesting, or when you have a good confidence level, is when you have this your time frame to be on a daily time frame or a weekly time frame. So imagine trading above a daily high or low, you expect more liquidities to be around that level, more like something like this now. So you've taken out the ERL, you still have this IRL, the liquidity here, and you are retracing into it. and you're retracing it to it. And whenever you're retracing it, you want to see a reduction in price action. You don't want to see an impulsive move towards the liquidity area. That's not is like a signal telling you that the price is going to break foot this liquidity area. But once you see that the candlesticks are reducing in sizes as you get close to the liquidity area, it's more like a good signal or a good sign that the liquidity area is going to hold. It's going to hold, just like here now. Are you seeing? That's how liquidity was being swept here. That's how liquidity was being swept here. So you're now going to enter this market from this level after a shift in market structure. Now this is a daily time frame, but you can always get this is a daily time frame here because this whole chart here is represented in the day. But what you're looking for is just a retracement to at most the 30% of this price action. So before now, you must have gotten your shift in market structure around this level after the sweeping liquidity, because you don't want to be looking at the daily time frame for a shift because it's going to take longer time. So you just go as low as 5 minutes, 15 minutes after the shift in this high here, after the sweep of liquidity above that high. You look for a confirmation here that will make you enter the market so that you don't have to wait too long. So what you just be expecting is just a short term sale. You don't want to stay too much in the market because you want to get what you want. Maybe 1:3 or something. You just sell, have your stop loss above that high. Then so at most any drawn liquidity, which is this one, you just target this liquidity and you're out. You're out of the market. Simple something. You don't really have to make it so complex. So why saying this? Let me show you example like a live trade I did some days ago. And there are other examples too I've made. You can watch other ones on the playlist. I talked about them differently, but this one I'm just explaining it detailedly. So let me take you to CAD CHF. That was the most recent candlestick theory um chart I had. CAD CHF. So now forget this. So this is CAD CHF. Yeah. If I should zoom in, see what happened here. This is the ERL, the external range liquidity. I told you external range liquidity are found below the lows because it's coming down to take an external range. Sorry, IRL internal range because price is coming in to taking an internal range liquidity. So the internal range liquidity are found around the lows here. So you look at this low now. This low was actually last 2 weeks low because this is a weekly time frame. If I should zoom in, you see that we have a sweeping liquidity here. So price swept liquidity at this low here. So after I saw that sweeping liquidity, I went to the daily time frame. After the weekly, you go to the daily time frame because I'm looking for a daily bias. So I went to the daily time frame to look out for the most recent sweep. And now you see on the daily time frame, liquidities has been swept over for a long time. Look at one, we have day one, we have day two, we have day three, day four, day five, day six, 7 days. So imagine sweeping liquidities below 7 days. You're going to have enough liquidity there, enough momentum, which was actually a good one. Now, after the sweeping liquidity, it was very visible from the daily time frame, which I know this is one of the criteria I have for the candle range theory entry model. I went to as low as 15 minutes to look for a shift in market structure because you know that whenever you're trading below any kind of liquidity, let's just say this is a liquidity, and imagine you have this kind of liquidity built here over time, and later on price just came in here and it took out this liquidity. It's going to give you a delivery in price action to some extent because liquidity here has been swept. And imagine having a sweeping liquidity from a weekly time frame. The price rejection is going to give you on a weekly time frame. It may not be up to 30% of the weekly time frame candlesticks. Let's just say this is what the weekly time frame candle range is going to be. It will not be up to 30%, but if you reduce it to the 15 minutes, 10 minutes, 5 minutes, the small rejection you're going to get from that weekly time frame is enough to give you a lot of money, because a weekly time frame rejection is like 1 week consists of 5 candlesticks here. So a weekly time frame rejection can take 2 days to get to 30% of it. I don't know if you're understanding me. Just like you have liquidity, if this is a daily chart here, and the CRT entry model is on the daily chart here, and after sweeping this liquidity from the daily chart here, this rejection after the liquidity can take maybe 1 day or 2 days to reject, to try like this. Then now imagine is a weekly time frame. It can take up to 4 days to reject. up to 30%. And at that 4 days, you're in that trade, which is going to give you more profit. So the higher the time frame you use to identify your CRT entry model is, the more um profit you tend to get in that market. So me identifying it from a daily or weekly time frame, it gives me an insight that at most 2 days is going to do the rejection before price continues trading. That's just what I'm trying to explain. So you can see now daily has been swept liquidity. Even if you did not see it on the weekly time frame, but you have taken out liquidity, then you go as low as 15 minutes to look for confirmation. Now on 15 minutes, what do we have? On 15 minutes, let me take this out. Let me take out this daily or this weekly line out. On 15 minutes, you can see you have another shift, or you have another sweep of liquidity here after an overall sweep in liquidity. So after a daily sweep of liquidity on the 15 minutes here, you have a sweep of liquidity here, which is also a good one. Then you have a shift in market structure. Price retraced back to this imbalance here. I have too many videos on FVG. You can do well to check them out. And if at all you need any corrections or explanation, you need any kind of a private mentorship or private classes, you can actually check on my description of my channel. There's a WhatsApp link there. You can join the group and we can get to talk. Just DM me, I'm the admin. So we get to talk about business. Back to the video. So we have a shift in market structure here. We have that liquidity has been swept here. We have a breaker structure here. We have the price that filled up this liquidity void. Tell me what else you need to enter this trade, because everything happening here now is like a complete price action playing out. Now looking at what is going on here. After a break of structure, what happened next? Price left this imbalance here. This FVG. If you don't know what an FVG is, I'm always here. You can go to my videos. I've talked a lot about FVG. So price created this liquidity void, which is an FVG, and retraced back into this FVG. And look at this lows now. I felt like this was liquidity. After this pushed, created another break of structure here. Look at price traded above this high. So this is a break of structure. So after this break of structure, I was expecting price to just trade up from here, because I saw this reaction or this rejection from this imbalance here, this particular imbalance. So I thought we were going to go above here. Then if we don't go above here, I was also looking at this level to be another second entry where price will, from here take out liquidity before going up. But that did not really happen, and this was what now happened. Yeah, price delivered, taking out this engineered liquidity. If you don't know what an engineered liquidity is, I have a playlist on my channel too talking about type of liquidity. So this was engineered liquidity. Delete that. I did not even trade that. I was just using it to explain something for my friend. So this was my target here. This place was my target here. I did not want to stay long in the market, because not like this was my. I did not want to stay long in this very trade because I just like this full movement. This was like a good delivery for me. But if you should check further, I saw further place where it could be a possible liquidity zone for price, which was this high. This high here, above this high. But since I like this liquidity I'm seeing, I just had to pick this level here. I just had to pick this level. See, it's as far as this. I just had to pick this level here as my liquidity, looking at this high. Liquidity has not been taken from this level for a very long time. So I just had to pick that level, which price actually delivered in full. So I was not too greedy with price action. Just take your liquidity and go. I actually took this trade and it got to take profit. Let me, show you my MT5 here. So this is what it looks like on my MT5 on the 15 minutes. Although there are some slight difference from these different brokers. You see most of the sweep you see there are not very visible, but I took this very trade and we got to take profit. So that's just it on CRT model. There are other examples I've made before now, but I'm detailing explaining it here. So do well to subscribe to my channel. If you don't have any idea of what this look like, you can actually DM me for private lectures. Also, my WhatsApp number is on the description of my channel, so just click on the link, join the group, then DM me from this admin. I'll be able to reply you. All right guys, thank you for watching, and see you when I see you.